You think about where we stand right now. I mean, you take a look at the fundamentals underpinning corporate America right now. There's a lot of bullishness about where profits, where earnings could go. But again, then you take a look at what's going on the geopolitical front, all of these headlines being volleyed back and forth. And that seems very much to be what's top of mind for markets heading into the weekend.
Yeah, so, Katie, I think it's important that we frame this in the right way right now, because I think the way what markets are thinking is they're really thinking about it as a tipping point. So right now what we have is a price shock going through. Oil prices, equities are following oil prices. There's no question about that. That's a price shock, right? That is something that's going to degrade value, that's going to degrade prices, I should say. Because effectively what you're going to do is you're going to discount your future cash flows at a higher interest rates. As oil prices go up, interest rates go up, and you're going to get a lower present value. That's a very normal reaction. But that's a price shock. That's temporary. That's something that can go away over time. But the debate, though, is does this turn into a growth scare, or does this potentially increase recession risk? Then it becomes a valuation shock. So what we should really be debating is the difference between a price shock and a valuation shock. And I will say that right now, my view is that we are in a price shock, meaning that we have to adjust to higher oil prices. Look at interest rates. Interest rates are rising, and that's an issue. But today has showed me something very significant, and that today's the first time really that the curve is steepened in the way that 2-year yields have come down and 10-year rates have actually gone up. That is now the market starting to think that we could be tiptoeing into more of a valuation shock, which is something that would be a longer lasting downturn in prices. We're not there yet. That's not my case. That's not my view. But overall, that's, I think, what the debate is, and that's what the market's worried about.
Well, Jim, I was going to ask you, what is the nuance there, between price and valuation in terms of how you're thinking about a portfolio? You mentioned that you do see the curve steepening today. So that might suggest that we're heading into a valuation shock, at least from the market's point of view. It sounds like what you're saying, though, is that perhaps that's something you would fade at this moment.
At this moment, I would. And the reason is that we don't have enough information right now. We have to recognize that the initial conditions, the conditions that preceded this war, were actually relatively good. Strong, robust data. Everything was going relatively well. And it's going to be hard to blow the U.S. economy off course, or even the global economy off course, but it can be interrupted, which means that we could be into a period of assessing what the damage that's been done from oil shortages and higher prices that could set aside some of the good growth news, and ultimately it's just going to take longer for it to really reignite. So I think we're in that waiting game at this point. We don't have clear information as to how long this is going to last, or even if it intensifies. So this is what the market's worried about. Look, it's a Friday. We're heading into the weekend. Saturday and Sunday we're not trading, so people are nervous and they're taking down risk.
Glad you bring that up, because we've been here before. We've seen big policy pronouncements followed by the weekend. The markets aren't open, and I'm curious how that past is giving you sort of an indication of sort of how you might process anything that happens here, process the bad news that we've seemingly gotten today.
Yeah, I think we have to think somewhat technically on a Friday going into, a weekend, with these types of events, because ultimately, this is a question of, do we start to take risk off the table? Do you want to go into the weekend with any long positions on? And the answer is probably not, right? And I think then Mondays, what we typically see is a rebound, right? If nothing bad happens over the weekend, it's status quo, then people take back prices. So I think we have to look at today's downdraft in equity prices with a little bit of a grain of salt, and just say that this is going to bounce around for a bit. But we're still waiting to hear if there's any improvements, because essentially what the market has to process is this whole concept of negotiated escalation. And this is what's happening, between the U.S. and Iran. It's a very common military tactic in these periods of time based on history, where you have a negotiation, but at the same time you escalate the military force. So that way you think both sides think they have a stronger seat at the negotiating table. That's a concept that's really hard for markets to process, because it just looks like things are intensifying and we're not making any improvements. But really, this escalation is being really thought of as the end game settlement, that you have to have this escalation before you get the actual negotiated, ceasefire.
Right.
And I think that's part of it.
All right, Jim, have to leave it there. Have a great weekend when you get there. That is Jim Caron. He is CIO of the Portfolio Solutions Group over at Morgan Stanley Investment Management.